All right, welcome everyone to The Explainer. Today, we're basically putting on our financial detective hats to uncover the true value of assets. You know, if you've ever stared at a stock market ticker and wondered, wait, does that blinking number actually represent reality? Well, you are definitely in the right place. Today, we're exploring the absolute bedrock of fundamental analysis, discounted cash flow valuation, or as it's commonly known, DCF. This quote from Oscar Wilde really perfectly captures our mission here. He once described a cynic as someone who, quote, knows the price of everything but the value of nothing. And honestly, in the world of investing, the market is giving us a price every single second of the trading day. But here's the catch. A price is literally just what people are willing to pay at a given moment. It's our job, our absolute imperative as investors, to dig deeper and find the underlying intrinsic value. So, let's jump right into this first section, price versus intrinsic value. We're going to find the hidden truth in finance. So what is intrinsic value? Well, it's the true underlying worth of a firm based entirely on its fundamentals. We're talking its cash flows, its growth prospects, and its risk profile. Why do we go through all the trouble of fundamental analysis? Because markets make mistakes. Sometimes they get completely swept up in the hype, and other times they completely panic. When we calculate an asset's intrinsic value, we're essentially making our best, most educated estimate, with the hope that the market price and our calculated intrinsic value will eventually converge. Moving on to the core DCF building blocks, let's open up the Financial Detective's Toolkit. Enter discounted cash flow, or DCF. This is the absolute foundation of fundamental valuation, and it's brilliant because it takes dense financial theory and translates it into a clear, usable number. The underlying premise here is actually remarkably simple, yet immensely powerful. The value of any asset is just the present value of the expected future cash flows that the asset is going to generate over its life. And where are we getting the data to do this? We just pull historical figures straight from a company's public filings, like their 10K annual reports, and use those to project future performance. Whether we're talking about dividends for stocks, coupons for bonds, or after-tax cash flows for a new business project, the core principle is exactly the same. So how do we calculate it? Think of this like an architect's blueprint for value. First up, the foundation. We estimate the cash flows the asset will actually generate. Second, we build a sturdy frame, which we call a discount rate. See, money in the future is way less certain than money in your pocket today, right? So we have to discount those future cash flows. Mathematically, you divide that future cash by 1 plus the discount rate, compounded for each year out into the future. And remember, the riskier the asset, the higher that discount rate goes, which mathematically shrinks the present value. Third, we need a roof. That's our terminal value, representing the firm's value at the end of our estimation period. And finally, step 4, we calculate the present value of all that combined. Now, we actually have a fork in the road here. There are two main paths in DCF, depending on what exactly you're trying to find. First, we can value just the equity. That's the cash left over purely for the owners after literally all the expenses, taxes, and debt payments are covered. To do this, we discount those cash flows at what's called the cost of equity. Or, path 2, we can value the entire firm before any of those debt payments are made. For this, we use the free cash flow to the firm, and we discount it using the weighted average cost of capital, or WACC. That's basically a blended rate of the cost of both equity and debt. Up next, achieving closure through terminal value. Time to peer into the crystal ball. Okay, here is the tricky part. We obviously can't accurately project year-by-year cash flows into infinity. That's impossible. So we have to impose what analysts call closure. To get that closure without doing infinite math, we calculate a terminal value. We project specific cash flows for a set period, say 5 or 10 years out, and then we just assume the firm eventually hits a constant stable growth rate forever. And let me tell you, this terminal value usually makes up a massive chunk of the company's total calculated value. Let's look at a real-world example with Coca-Cola. We are putting the math to the test. This brilliantly illustrates our first step in action. Take a look here. Notice how Coca-Cola's expected growth rate is slowly, gradually stepping down from 7.88% in year 6 to a very stable 3% by year 10. We take their projected earnings per share, apply an increasing payout ratio, and boom, we find the actual expected dividends. Then, using that exact discount rate math we just talked about, dividing by 1 plus the cost of equity, compounded over time, we figure out the present value of those specific future dividends. Now for the really fun part, bringing all those puzzle pieces together into today's dollars. Here, we combine the present value of the free cash flows to equity from our high growth and transition phases, that's the $82,285 million you see right there. Then we add that massive terminal value of over 291,000 million discounted back to the present. Oh, and we definitely don't forget the cash they already have just sitting in the bank, so we add back 8,517 million. Add it all up, and we get a total value of equity today of 218,715 million. So we have the total value of the company's equity. But as an everyday investor, you probably want to know what one single share is worth, right? When we divide that total equity by the number of shares outstanding at the time, which was just over 2.2 billion shares, we get our big reveal, an intrinsic value of exactly $95.54 per share. And wow, this is exactly where the detective work pays off. Because get this, the market price was only $68.22 at the time of this source data. Our DCF calculation of $95.54 literally proves that relying entirely on market hype or pessimism is so dangerous. According to our fundamental analysis, Coca-Cola wasn't just a solid company, it was a massive bargain, trading significantly below its intrinsic value. No way around it. Let's look at one more real-world example, Disney. This time, we're valuing the entire firm. So Disney has a much more complex structure with some significant leverage. Because of that, we estimate the free cash flow to the firm, the FCFF. Remember from earlier, these are the cash flows generated prior to making any debt payments. And since we are looking at the whole firm, we can't just use the cost of equity to discount it. We have to use the overall weighted average cost of capital, or WACC, which beautifully accounts for both their debt and their equity financing. This 10-year projection here is an absolute masterclass in DCF. We project the free cash flow to the firm growing steadily from 451 million up to over 1.5 billion. Then out in year 10, we calculate a huge terminal value of $39.5 billion to represent Disney's value from year 11 into perpetuity. Using our compounding math, we apply the cumulative cost of capital to carefully discount every single one of those future numbers right back to the present day. So after discounting all of that, the value of Disney's operating assets comes out to roughly 21.5 billion. We add their cash on hand, and then here is the key step. Because we valued the entire firm, but we only want to know the value of the equity for the shareholders, we have to subtract out Disney's almost 11 billion in outstanding debt. Divide that remaining equity by the number of shares, and we land on a final intrinsic value of $22.77 per share. So, we've seen the math. We've walked step by step through the blueprints of DCF, and we've seen the hard evidence of how it uncovers hidden bargains. Which leaves us right back where we started with Oscar Wilde, asking ourselves this absolutely vital question about our own portfolios. Are you letting the wildly fluctuating market dictate what you believe a company is actually worth? Or are you doing the fundamental analysis? Do you know the intrinsic value of your investments, or just the price? Think about that the very next time you look at a stock chart. Thanks so much for joining me on this explainer, and hey, keep digging for that underlying value.